Published 0249 EDT, the 29th of August 2017. Updated 0249 EDT, the 29th of August 2017. Fund management has its fair share of superstars with names like Neil Woodford, Nick Train and Terry Smith almost household after years of stellar returns. Investors who backed these managers early have reaped the reward, but who should investors be backing today to make the most of their money in the future? According to Darius McDermott, managing director of fund ratings firm Fund Caliber, Holly Castle of Neptune Investment Management is one to watch. Castle was promoted to co-manager of the Neptune UK Opportunities Fund and deputy manager of the Neptune UK Mid-Cap Fund in May. After a meteoric rise through the ranks, This Is Money spoke to her to find out what makes her tick and why investors should be interested. Holly Castle now co-manages the Neptune UK Opportunities Fund with the fund house's investment director and head of UK equities Mark Martin. Castle joined Neptune in September 2013 as an investment analyst, having previously qualified as a chartered accountant at Deloitte. She graduated from Oxford University in 2009 with a degree in philosophy, politics and economics. She now shares the reins of the Neptune UK Opportunities Fund with Mark Martin, the firm's investment director and head of UK equities. The fund invests in UK companies, including those the duo consider to be special situations where companies are out of favor, misunderstood or where management changes or takeovers are expected. Ongoing charges are 0.98%. Its largest holdings are retail technology firm PayPoint, UK defence specialist Ultra Electronics and telecommunications firm Spirent Communications. Its portfolio of around 30 stocks fall within a silo approach to investment, with each holding categorized as one of three themes: economic recovery, structural growth, and operation turnarounds. This is to minimize correlation and to serve as a hedging strategy to moderate downturn risk, Castle explains. I view the mid-cap fund as his baby and I help where and when I can, but there is a greater potential to put my own stamp on the Opportunities Fund while using the market expertise Mark has built up over the years, she says. Holly Castle said there have been some good investment opportunities in the FTSE 250 following Britain's vote to leave the EU. Have a collaborative approach. In terms of buying stocks, Mark and I will run our own investment screen. We often find a lot of crossover when we compare the findings of our research and often select these companies. When it comes to selling stocks, we have price targets. This does not mean that a stock that hits its targets would be sold straight away. We reassess the investment case for these stocks. It may be the stock has simply had a good run of positive performance. One company that Castle pushed for inclusion in the portfolio is British multinational firm Babcock, which specializes in support services managing complex assets and infrastructure in safety. The company's share price has plunged over the past 5 years by 43% from a peak of 1,471p at close of the 28th of February 2014 to 844p as at the 31st of July 2017. But Castle believes she has stumbled across a gem here. She says recent sentiment on the support services industry has been negative and Babcock has been affected by that and sold off unfairly. But on closer inspection, the contracts they hold, particularly with the Ministry of Defence, show that it, in fact, remains a good quality proposition. One of the more pertinent challenges that Castle and other UK-focused fund managers have to contend with is political uncertainty stemming from Brexit negotiations. Castle, who served in the investment teams of both funds prior to her recent promotions, says the holdings of both funds were means-tested based on valuation ahead of the contentious referendum. Name Neptune UK Opportunities ongoing charges 0.98% return to the 15th of August 2017, 1 year 14.03%, 5 year 73.70%, 10 year 199.90%, yield 2.05%. There were plenty of opportunities to be found in firms in the FTSE 250 in the immediate aftermath of the vote, she explains, because of the perceived implications that a fall in sterling would have on the UK's medium-sized businesses. What most people fail to realize, Castle suggests, is that around 50% of the revenues generated from FTSE 250 companies come from overseas, and would therefore benefit once the cash is translated back into pounds. A cloudy macro picture presents difficulties, but what we can do is focus on good companies that are undervalued. We try not to focus too much on politics. The fall in the pound over the past year or so has made Britain's businesses susceptible to foreign takeovers as it provides foreign investors the opportunity to snap up quality British firms at a discount. However, the political uncertainty that followed Britain's shock vote to leave the European Union has chilled the appetite for mergers and acquisitions of British companies to the lowest level in at least 2 decades as bosses grapple with what Brexit will cost. Thomson Reuters data of pending and completed mergers shows the number of deals involving UK companies fell to 707, a total value of £66.2 billion, in the 11 weeks immediate after the Brexit vote, down from 1,060 deals worth a total of £94.7 billion in the same period last year. The line graph shows the growth of the Neptune UK Opportunities Fund versus the Investment Association UK All Companies sector over the past 5 years. Castle says we are likely to see more M&A activity in the future. It has taken some time for acquirers to have confidence in UK PLC amid a volatile political situation. We do not invest in companies based solely on the fact that they are likely to be subject to a takeover bid from overseas. However, it could tip the decision. How does the market view Castle? Castle has drawn high praise from fund caliber's McDermott. He said, "We've been very impressed with Holly. She is extremely knowledgeable about all the companies held within the fund, as well as the wider market, answering questions articulately and with ease. Anyone seeing her present could be easily mistaken for thinking she has run money for a long time." The Neptune UK Opportunities has endured a highly volatile time since May, with returns dipping in and out of the red on numerous occasions over the period. The fund returned 0.8% over a 3-month period to the 28th of July 2017, 1.5 percentage points below the Investment Association's UK All Companies benchmark. Of course, it would be desperately unfair to judge Castle over such a short investment horizon. After all, the rule of thumb is to stay invested for a minimum of 5 years. Over this period, the fund outperformed the benchmark by just under 5%, returning 80.1% versus the benchmark's 75.5%. Only time will tell whether she lives up to her billing. McDermott gives his views on the rising stars of fund management. We asked Darius McDermott for 4 further rising stars to look out for. Here's what he said. Alex Savides, manager of JOHCM UK Dynamic Ongoing Charges 0.85%. Alex has shown himself to be a very talented and determined investor. His fund is still virtually undiscovered by the broader investment community. Alex designed the fund himself and has run it since launch, managing to be consistent in all market conditions. Alex joined JOHCM in 2008, initially as assistant manager on their UK growth fund, and holds over 15 years industry experience. He has a degree in politics from the University of Nottingham and has previously worked at Astaire Partners and Numis Securities. Chris Kinder, manager of Threadneedle UK Extended Alpha Ongoing Charges 0.84%. Chris joined Columbia Threadneedle in 2010. He is also responsible for coverage of the aerospace and defense, oil services, mining and banking sectors, and for idea generation for the wider UK equity team. Before joining the company, Chris was an assistant fund manager at RWC Partners. He has also worked at Govett Investments, gaining experience in smaller companies analysis. Chris holds a degree in modern European languages from Durham University. He also holds the Chartered Financial Analyst designation. We think it is a great core UK equity holding, with the added advantage that Chris can short a small number of stocks if he wants to. He's got a great track record through different markets. Douglas Brody, manager of Baillie Gifford Global Discovery Ongoing Charges 0.77%. Douglas graduated with a BSc in molecular biology biochemistry from Durham University in 1997 and with a DPhil in molecular immunology from the University of Oxford in 2001. He joined Baillie Gifford in 2001 and is head of the Global Discovery team. He's been managing this fund since launch in 2011. The fund is pretty punchy and has a bias towards smaller companies with big growth prospects. Companies that are benefiting from structural change, possess a disruptive technology or a desirable innovation. James Thompson, manager of Rathbone Global Opportunities Ongoing Charges 0.79%. James is a great fund manager who seems to stay under the radar somehow. He joined Rathbones in October 2000, having graduated from Cornell University in New York with a Bachelor of Arts degree. He was appointed as a board director of Rathbone Unit Trust Management Limited in November 2006. He's managed this fund since 2003 and has evolved his process over the years. He added a defensive bucket of shares to the portfolio post 20,082,009 and has since delivered very good consistent results for investors. He's also not scared to admit when he can't add value somewhere. For example, he rarely invests in emerging market stocks as he doesn't have the access to research or know the markets well. He sticks to developed stocks and markets where he knows he can be good. We like that quality in a manager.